Welcome to The Explainer. Today, we are unpacking a truly historic boom that is completely transforming the Australian gold mining sector. We are talking about a massive convergence here. Huge global macroeconomic tailwinds colliding with unprecedented local currency benefits and some seriously aggressive, highly strategic corporate moves on the Australian Securities Exchange. It's a fascinating time for the resource sector, and we're going to break down exactly how this whole Gold Rush 2.0 is playing out right now.
Here is the roadmap for today. We'll kick things off with the big global picture, the macro forces driving gold, before we zoom right into Australia's new golden era. Then, we'll hit the gritty reality of the cost crunch that miners are dealing with, explore the clever regional hub strategies they're using to fight back, and wrap up with the risks and overall outlook for the sector. Let's get into it.
Now, I want to start with a quick question that might actually surprise you. How on earth did gold quietly become Australia's second most valuable export? I mean, it's a massive macroeconomic shift. If you went back to early 2024, nobody was predicting this. But right now, gold has literally leapfrogged liquefied natural gas, LNG, in export value. It's sitting right behind iron ore.
Okay, Section 1, the global gold boom and its macro drivers. To really grasp this local shift, we first need to look at the sheer, mind-bending scale of the global market as we move through 2025 and 2026. What's truly staggering here is the sheer volume of capital moving around. In 2025, global gold demand blew past 5,000 tons for the very first time in history. That pushed the total market value to a record-breaking $555 billion US dollars. The gravitational pull of a market that size is absolutely immense.
So what is pouring fuel on this fire? Well, it's kind of the perfect storm. First up, persistent central bank buying. Countries like China, India, Poland, and Turkey added over 1,000 tons to their reserves in 2025 alone, and a lot of that is driven by this wider trend of de-dollarization. Add to that the US Fed cutting interest rates, which obviously lowers the opportunity cost of holding gold, plus, intense safe haven demand from ongoing geopolitical tensions.
And look at the result. By early August 2026, the spot gold price surged to near record levels, around $4,350 US dollars an ounce. When you price that in Australian dollars, man, it amplifies those gains significantly whenever the Aussie dollar is soft against the greenback. We are talking about massive, unprecedented revenue potential for local miners.
Which brings us right to Section 2, Australia's new golden era and the local impact. Let's shift our focus and see how this global price action is fundamentally altering the Australian economy and turning the ASX into an absolute global hub for gold investment. Just look at this massive jump. National gold export earnings sat around 47 billion Aussie dollars in the 2024-25 fiscal year. But thanks to this historic price rally, projections for 2026-27 have surged to between 73 and 74 billion dollars. That right there is exactly why gold is now accounting for roughly 16% of the nation's total resource and energy export value.
But actually, scratch that. It's not just a price story. It is a volume story too. This pricing environment is physically scaling Australia's output. We're looking at a jump from 293 tons to a projected 369 tons by 2026-27. That is roughly a 26% expansion in sheer physical volume being pulled right out of the earth.
So where is all this newly mined gold coming from? Well, Australia is arguably the largest producer globally right now, driven by major heavyweights in Western Australia. Think the Leonora-Laverton district and the Pilbara. But crucially, we're seeing new regions taking serious prominence, like the Paterson province, which is where Greatland Resources is based. Add to that highly prospective operations over in Victoria and New South Wales, plus some emerging high-grade stuff in the Northern Territory.
But hey, before we get too carried away with all these record revenues, we definitely need a reality check. Let's dive into Section 3, navigating the cost crunch. Because the operational headwinds facing these miners right now, they are incredibly severe. As anyone following this space knows, the most important metric to watch is AISC, all-in sustaining cost. This is how the industry measures true profitability. It's not just the cost of digging up dirt, it factors in capital expenditures, corporate overhead, and environmental reclamation. It's the total, fully loaded cost of keeping the lights on and the gold flowing.
And here is the absolute squeeze. The underlying cost of pulling that gold out of the ground is inflating incredibly fast. The global average AISC has climbed from $1,310 US dollars per ounce in 2024 to an estimated $1,410 by 2026. Top-line revenues are high, sure, but the floor is rising up to meet them very, very quickly.
And this brings us to a frankly bizarre mathematical paradox in the mining industry. Much of this cost inflation isn't happening because miners are suddenly getting bad at their jobs. It's actually because higher gold prices trigger exponentially higher ad valorem royalty payments. When the gold price surges, the percentage cut paid to governments and landowners surges right along with it, which artificially inflates those reported cash costs.
So when you compound those escalating royalties with massive structural labor shortages, highly volatile diesel and energy costs, and the harsh reality that global discovery grades are generally declining across the board, well, you get a highly demanding operational environment that aggressively eats into those record top-line revenues.
So how do you survive and actually thrive in that kind of environment? Let's move to Section 4, the Regional Hub Strategy. This is the clever strategic pivot ASX mid-tiers and majors are using to maximize ROI right now.
The old way of doing things, the standalone model, meant if you found a deposit, you had to build a brand new, wildly expensive processing plant right next to it, requiring massive capital expenditure. Today's winning playbook is the hub-and-spoke model. Instead of building new mills, smart miners are acquiring adjacent deposits and routing that high-grade ore straight to existing centralized processing facilities. Low capex, high efficiency.
A textbook, real-world example of this is the mega merger between Genesis Minerals and Vault Minerals. By merging, Genesis can just take ore from its undeveloped Tower Hill project and drive it 35 kilometers down the road to Vault's massive, existing King of the Hills mill. That one logistical move saves Genesis $500 million in capex and unlocks an estimated $2 billion in post-tax synergies over 10 years. It's absolutely brilliant.
And we are seeing this consolidation playbook everywhere. Remelia bought Spartan, Alkane merged with Mandalay, and Northern Star is expanding massively. But a truly standout example of this hub-and-spoke model is the emergence of Great Lean Resources. Following their blockbuster acquisition of Telfer and Havrion, they've shown incredibly strong ROI. And their organic near-term growth potential? It's huge. By linking the high-grade Havrion deposit directly to the existing Telfer infrastructure, including the Telfer waste dump processing, they bypass massive capital costs. It's the ultimate execution of this regional hub strategy.
All right, let's bring it all home in Section 5, Risks, Opportunities, and Outlook. Let's weigh the balance sheet strengths against those future headwinds to get a clear picture of where the ASX gold sector is heading over the next few years.
When you look at the major players, you see a real divergence in production scale and cost discipline. Northern Star is moving an absolute mountain of gold, over 1.5 million ounces. But look closely at Evolution Mining. Because Evolution mines copper alongside their gold, those copper byproduct credits keep their AISC astonishingly low, at just 1,717 Aussie dollars an ounce. That thoroughly insulates their profit margins against inflation.
Overall, the sector's outlook is incredibly robust. You've got ASX miners boasting strong, often debt-free balance sheets, excellent dividend stability, and a serious focus on high growth. These high prices are totally reviving exploration budgets for those crucial high-grade deposits. But it's not a free pass. Establishing a social license to operate is tougher than ever. Navigating stricter ESG compliance, mandatory climate reporting, and vital heritage standards has permanently elevated the baseline cost of doing business.
Which leaves us with this final thought. We all know the global push for electrification requires massive, unprecedented amounts of copper, lithium, and other critical minerals. So, looking long-term, will those energy transition metals eventually outshine gold entirely? Or will these highly capable, cost-disciplined gold miners continue to strike it rich in this new era? It's a fascinating dynamic, and one we'll definitely be watching. Thanks for joining me on this explainer, and keep learning.